I am Brandy Whitmire. I am a direct lender, a broker, a banker. We are nationwide. We have most products under the sun, and if we don't, like I said, all the time, we can get you to the right place. So again, today's topic is how to pay down the balance of your home faster. Some simple ways and some non-aggressive and some aggressive ways of how to pay down your mortgage faster, and also why it works. So I'll explain all that at the end. But first, something very simple as paying an extra 50 to 100 bucks a month on your mortgage can make a very, very huge difference. So let's say your mortgage payment is $1,400 or $1,350 or whatever the case may be. Just pretend or just make an auto draft of $1,400, $1,450 and let it go on auto. Just pretend like it's that payment, and that can literally save thousands off of your balance or off of the interest that you would have paid over the life of the loan just in a few short years. Even if you're planning to sell or refinance, the amount of equity that you're going to have is going to be much greater at the end, even with just a 50 to 100 bucks a month. The second way is what most people tell you, and that's to make one extra payment per year. So you have a $1,400 payment, make an additional $1,400 payment at the end of the year, which is, I think, is hard for some people to come up with that lump sum at one time, but that's going to dramatically change the amount of interest that you're going to pay over the life of the loan, whether it be a 30, 15, 20, it doesn't matter. It's going to make a huge difference over the life of the loan and the interest at that time. The third way is doing a biweekly payment. Now, essentially, doing a biweekly payment is the same thing as making one lump sum. Now, I like this a lot better for two reasons. One, most of us get paid twice a month. So if you're getting paid twice a month, you can divide out your mortgage payment, and with that paycheck, or if you have one that's more of a commission type situation, do maybe more on that one. But if you can divide out your mortgage payment, remember, you need to go 15 days before, not after, right? It's the sooner that you pay down the debt. But if you can divide out your mortgage payment into two and just make it come out of every single check, then your balance goes down faster, which means the interest that you're paying on that balance, it goes down faster. So you pay interest off of the balance alone. That's why it works. One is because you're paying it down faster. That's why I like that better than one lump sum at the end of the year, because you're actually slowly chipping away at it during the year. And also I like it because you don't have to come up with one lump sum at the end of the year or whenever you get your bonus, whatever the case may be, because you're already making that extra payment with your paychecks. Hey, Steve. So that's why I like that biweekly payment a lot better. It's not as aggressive as trying to figure that out at the end of the year. And now it's Christmas time. What am I going to do? And it's easier to manage along with your paychecks. The fourth is obviously, the fourth is actually going to be get with your lender and see what a 15-year or a 20-year payment would be, a shorter term payment would be, and just practice making that payment. See what you can do is practice making that payment on an auto draft for a few months and see if you actually see that money. You might be surprised at what a 15-year payment, now do that on what the current 15-year rates are, but you might be surprised that a 15 or 20-year payment might not be as much as you think. So you can start practicing making that payment, which leads into the next one is to actually, obviously, refinance into a lower payment. Okay, so you might be surprised how feasible it is to go from a 30-year to a 20-year after a few years. Because after a few years, if you have more equity in your home, or let's say you're paying mortgage insurance on that FHA loan or on that conventional loan that does not have 20% equity yet, you might be surprised that a 20-year payment for you might not be that much more. It might be the same. And if you go to a 15-year, since the rates go lower the shorter the term that you go. So having the shorter the term, the lower the rate typically, right? And the shorter the term, the lower the mortgage insurance rate as well. So let's say the conventional loan at 30-year conventional loan, that's 5% rate with $150 in mortgage insurance. Well, a 20-year would be maybe 4.5 or 4.75 with $100 of mortgage insurance. Then a 15-year might be 3.5, or sorry, 4%. Let's say 4%, 3.875 with $50 or $80 mortgage insurance. So it goes lower as you shorter that term. So you might be really surprised, especially if you're able to get rid of that mortgage insurance because it's been a couple years or you've done some improvements and you actually have some appreciation if you're in your home, and now you have the equity that you need, because the more equity that you have, the lower your rate's going to be as well. So look into, you always want to look and get with your mortgage professional and look and see what your current value is, what the current rates are, because the rates change dramatically during that process, and rates change daily. We could have something happen tomorrow and we could have a half a point, it could go half a point lower tomorrow. I've seen it happen before in my career. It's not happening that much right now, but it could, and it will again for sure. It's going to happen again. So, and let's remember, at the end of the day, your plan is to either, one, pay off the house or sell it, right? Your plan is to pay the house off, not have a payment again, or sell it. So what that means is, at the end of the day, the balance is what matters. How much you are going to take home whenever you sell it, the equity, how much you are going to leave into, or how long you're going to make that payment, how much you're going to leave to your heirs. But most people don't pay off their homes. It's actually not, anyway, that's another subject. That's a different consultation. But anyway, just make sure you're always checking. It's always smart to check it out anytime. Figure out what the current rates are, what your value is, and see if you can reduce that insurance payment, which leads me into my next one. Your hazard insurance. Everybody has to have hazard insurance on their home. So make sure you're also getting with your insurance professional every so often and applying the discounts. The older you get, the better discounts you have. Let's say you had some some claims on your house before. Let's say you had some tickets or a car accident before and you have a multiple discount. Always get with your insurance professional as well and make sure that you're being applied the discounts that are readily available to you. The same goes with mortgage. You always want to be checking, and same goes with your credit card companies. Make sure you have the right rate, the right interest rate. Call, get a request for a higher credit line, request for a lower interest rate. You should be doing this at least every 6 months out of the year to make sure that you're not paying more than what you need to. So again, always check with your insurance professional. That can reduce your total monthly payment, which in turn gives you more money to pay on to that balance. And the eighth way. So some people have like an annual bonus or a high commission check. Whenever you get a high commission check, if you can commit to, if it's over this certain amount, I'm going to apply this to my mortgage, set my mortgage balance, and set those kind of parameters for yourself. At that point, I have friends that are consultants, and every March they get their bonus, and they will put the entire balance or that entire check onto their mortgage balance, but of course onto higher interest debt first. Higher interest debt first is always going to be more important, right? But that is the eighth way that you can pay down your mortgage faster. So lastly, I want to talk about why this works. Things to remember and why it actually works. So remember that you are paying interest on the actual balance of your home, okay? Even though the payment to you stays the same, so your payment's always going to be $1,400. The way that those funds are being allocated are different in regards to principal and interest. So the lower your balance of your home, which is why these really work, like paying down your, paying it bi-weekly and things like that. That's why this really works, because the more that your balance is down, the more of your payment, your principal and interest payment, goes towards your principal, that money back to you, your house bank account, than it does the interest of the home. So 4%, if you have a $100,000 loan, you're paying 4% on $100,000. If it goes down to $97,000, you're paying 4% on that $97,000, not that $100,000. It's not fixed in that way. And that's the misconception, that part is fixed. It's not. You pay 4%. The 4% is what's fixed if you're getting a fixed rate. 4% is what's fixed, and the payment stays the same, right? but where those funds are being allocated are different. So always remember that. Even that's why paying an extra $50 works. That's why you can shave 7 to 8 years off of your payments just by making an extra $100 payment a month, or that extra payment, or that biweekly payment per year. Okay. Also, one thing to remember when refinancing, people say, I don't want to refinance, I don't want to add closing costs. Remember that refinancing does not always include closing costs. You can keep the same balance in some cases. So always reach out to us and see if that situation fits for you. You never know. In a lot of cases, I can pay for the closing costs and some of the new escrow account, where you actually make money on that escrow account. You never know. So reach out and see if that's available to you. You don't have to pay closing costs. That's not closing costs are still there. You're paying for it with a rate. So let me make that clear. The closing costs are still there, but you're able to use your rate for lender credit. In some cases, that makes more sense, so that you can take that money and put it back onto your balance. In some cases, we would need to consult you on that, of course. That's not always the best way. A lot of times right now it is so. And also remember, when you are refinancing, interest is paid in arrears. So you don't make a payment until the month after you close. Okay, so if you're closing this loan in January, you're not making a payment until March. So if you chose not to make your January payment, remember that you have to close and fund in January. Never ever go 30 days late on your payment. Ever, ever, ever. Never be late, 30 days late on your mortgage payment. But let's say you chose not to make that January payment. You will not have your February payment, right? Because you're paying interest in arrears. You're still paying taxes and insurance. Those things are still being calculated and all that. However, that tangible money that was going out, you can take that and throw it onto your principal balance. So if you have a $1,400 payment, think about that. That's $2,800 that you can throw onto the principal balance. Keep in mind, we're talking about principal and interest here. You're still paying taxes and insurance. That's still being put into the new loan. And all those funds are still being allocated. Because I know I'm going to have people say, oh, you do pay the interest. You're not skipping a payment. I'm not saying that. You take that tangible money that was coming out of your actual bank account and taking it and putting onto your principal. In most cases, it's going to be better suited for you to pay down that balance faster. Okay, so and the last thing to remember is, if you were escrowing before on your previous loan, anything that was in that escrow account, which is basically like a piggyback bank account, anything that was in that escrow account is going to be taken to you as a check in the mail within 30 days of closing and funding of the new loan. So if you had $2,000 in that account and you had to renew your new loan and add $2,000, $2,500, whatever, depending on if you have a new escrow account or not, which is up to you if you have 20% equity on a conventional loan. But let's say you have remember that $2,000 check, or however much is in that escrow account in your old loan, is going to be cut to you in a check. I just had a friend the other day say, hey, I got this $2,500 check in the mail. What do I do with it? Do I send it back to the bank? I'm like, no, it's yours. They already redid your escrow account. She's like, wow, I can now go pay off. I'm gonna go pay off my city card. That, I was like, yeah, definitely. That's the way to leverage money. That's the way to pay off things faster. That's the way to manipulate what you have. That's why owning a home is so important. Not only are you building equity in something, unless you're an investor, then that's another thing. You can do things different ways. But you're building equity in something. Your house is basically a bank account. Yes, it fluctuates up and down in value, but at least you are paying towards something. And with refinancing, you can manipulate money. You can manipulate it. That's why I'll always have a couple of houses at least on single family that I can refinance, because you can do that every year. So anyway, those are your tips on how to pay off your mortgage faster, and things to remember. These are very, very important and things to think about whenever you're going forward. So if you have any questions on that and how to, and if any of this makes sense for you, then please reach out to us and go to brandywhitmire.com. Remember, we're a nationwide lender. If we can't do it, we'll find you the place that can. And you can reach us at our office at 214-660-5000. And I will see you again next week. Hope to talk to you soon.